All right, welcome one, welcome all. It's another episode of my video today, and what I wish to share with you today is initially I wanted to talk about what how to find, because I'm always talking about not using volatile stocks and things like that, and people always ask me, how do you identify a volatile stock from a non-volatile stock? I've been getting that question for quite some time. My intention was to answer that today, but that will be for next week because right now it's a war room situation. Nothing to panic about. It's just about the upcoming debt ceiling of the United States of America. Now, if you're not familiar with it, it's something you can Google it or YouTube or do your research to find out what the debt ceiling is and how that affects the economy. And what you know what they say, the U.S. sneezes, it affects everybody else, including ourselves here in our little Republic of Ireland. That being said, what am I doing in preparation for this issue? Because it seemed to be like it's going to be a different situation this time around. They've been having this issue of raising the debt ceiling for decades now, and it seems there's the Democrats and the Republicans can come to an agreement on what to do, and that's creating a lot of panic and a lot of drama. That being, well, since that is the case, most people like to prepare for the worst, including myself. But I've always been preparing for the worst, which means that I'm doing absolutely nothing. Yeah, in my opinion, first I'm going to share my opinion, but then I'm going to be objective about it afterwards. In my opinion, uh, you should always you should structure your portfolio in a way that even if there's a crash or a situation of a black swan or a bear market or whatever like that, you shouldn't take too much of a hit. Now, if you're going to structure a portfolio like that, it also means when the market skyrockets, you wouldn't be participating in the full-blown skyrocket. So it's a give and take, catch 22 if you may. You either structure it that it's a bit conservative, that when when the market is rising, your portfolio doesn't rise as fast, but then when it's crashing, it doesn't crash as fast either. Or you just try to beat the market, buy the S&P, Vanguard S&P, VOO, VTI, Dow Jones, and all the good stuff like that. So, but I've always had, as most of you who've been following me know, I've always had the SPXU, which is a leveraged inverse ETF. I've always had at least 100 shares of that I sell calls on a regular basis. The reason I have that stock is because when it's been coming down for so long that it doesn't really go down too much. It's trending down, so it kind of loses value, but it's not losing in huge percentage. And the calls, someone get this B out of here. And the calls that I'm selling is making up for that. I'm just, I'm not, the premiums I'm collecting for the call, I'm not reinvesting that in the same stock. I'm just adding it to my portfolio as cash. And when there's a drop in the market, as some people would expect, my SPXU will spike up and then I can sell it when it goes up. So that's the stock I'm kind of playing with. My main the bulk of my stock will be of my portfolio will be in the Russell 2000, which is the only major ETF that I have for now. I'm looking. SPY is the next one I'm looking to buy, but I'm not quite there yet. I'm not quite there yet. Okay, we're not millionaires or the hundreds of thousands there yet. We're still working our way up. So we're in the building phase. Um, when if there is going to be a dip in the market, my SPXU is going to spike. Now, besides the SPXU, I also have the SH. Now, I didn't buy the SH, which is the inverse, not leveraged, but just the inverse ETF of the S&P 500. I didn't buy the stocks itself. I bought a call option for that. Now, if you've been a student of mine, you know what call options are by now. And if you know about covered calls and uh, cash secured puts and all that, you should know what that means by now. If you don't know what that means, you're leaving a lot of money on the table. You might want to give me a call. Okay, so I bought calls for that in January. Now it has been steadily declining, but that's fine. I bought a call for 150 bucks. Look, if 150 bucks disappears down the drain, That shouldn't bankrupt your portfolio. I just bought it because I wanted to see how it does for the next year. It expires next year, so it's a 1 year call option that I bought for SH just to see how it does. And so that's how my portfolio is structured. The SPXU is there, the SH is there. But for those of you who don't have those, you might want to consider stocks that are inverse ETFs at this point in time, or don't do anything. Just go down with the market. If it does go down, I'm not saying it will. If it does go down with the market. This is my opinion. And if and when it's going to come back up, it comes back up with you again. So you just write it down, you write it up, whichever the case may be. But if you're too scared, you might want to hedge. This is where people start buying cash protective puts and covered call, and call options on some stocks. The stocks you want to look at call options on or to buying calls on are like VIX, the VIX. I might have it on the screen on that side or this side. I don't know where I'm facing, most likely on that side, or even covering the whole screen. VIX. If you look at the VIX, I'm going to put a chart out there. If you look at every time the market has gone into a dive, VIX has spiked. The two major ones we've had so far, let's look at 2008 recession. Look at what the VIX is doing in 2008. And let's look at 2020, which is the recession one. Sorry, what's that called? COVID, as some people shouldn't mention. Okay, the lockdown time for the lockdown, or time that we had the lockdown. Look at what the stocks did and look at what VIX did. So whenever the stock market is plunging, there's fear in the market, volatility is high, the VIX is shooting. You might want to look into that if it's something you're interested in. But instead of buying the whole VIX, make sure you have the money to buy the whole VIX, but just buy the call on that. That's one way. You can also buy uh, calls on the SH like I did, or buy calls on SPXU, any inverse ETF. The way they operate is if the market is coming down, they are going up. When the market is going up, they are coming down. That's the way they operate. So they're inverse to the market. You can look at those. Now, that is my opinion on if you want to hedge. Or if you have stocks right now, you can buy in that are in hundreds. If you trade options that are in multiples of 100, you can buy a cash secured put, which is like an insurance. People don't know you can insure your stock. Yes, you can. Okay, you buy protective puts on your stocks, not cash secured puts. Protective puts on your stocks, and that's an insurance. I'm not going to go into that now. Now, that's my opinion. My Now, to be the objective side, this is what I see. I think they're just creating drama for the sake of creating drama. Eventually, they're going to come to an agreement and they raise the debt ceiling again. I don't think any president wants the whole economy and the dollar and everything come crashing down in their own tenure. So I think they're going to keep pushing it and they'll work something out just in the nick of time and raise the debt ceiling and everything will be back to normal. Okay, so no need to panic. And if there's a crash, yeah, well, there's a crash. If there's a crash, there's a crash. Be prepared for it. And if there is none, write it as it is. So that's my 2 cents. And that's what I have for you guys today. Next week, I'm going to be talking about how you can how to, not how to find, but how to determine if the stocks you're looking at is a volatile stock or is not a volatile stock. I always say stay away from volatile stocks. All right, that is it from me to you. Catch you next time.